The silver price you see on your screen is not the silver price the world is paying, and that gap is getting louder this week. The force that wants you to believe everything is fine is the clean, liquid, efficient paper price. Because paper trades fast, it trades big, and it trades in size without anyone having to touch a single bar. But the mechanism the mainstream keeps missing is this. Stress shows up first in the plumbing, not the headline. It shows up in spreads, in the cost to borrow metal, in where the inventory is sitting, and in how quickly available turns into not for sale. And if you stay with me, I'm going to give you the exact checklist for the next 1 to 2 weeks. What level matters, what confirms the thesis, what breaks it, and why the next calendar window can force paper to chase physical in a way most people won, see coming until it's already moved. Because the moment you understand paper versus physical, you stop being emotionally whipped around by every spike and slam. And that's where the real pressure starts. Right now, the context matters. In the first days of January, gold has been hovering in the mid-4,000s, pushing into record territory recently, and still swinging hard week to week, while silver has been living in the 70s and even tagged above $80 earlier this month before snapping back. Exactly the kind of violent headline-making action that shakes out weak hands, even when the underlying story is tightening. You can feel it in the tape. Sharp bursts up, sudden air pockets down, and the kind of intraday reversals that make people swear the market is rigged when the truth is simpler and more brutal. Liquidity is thinner than it looks, positioning is heavier than it admits, and the collateral rules of the paper market are doing what they always do under stress, forcing reactions. But that's not the part that matters. The part that matters is what gold holders need to understand about silver, because silver is the stress test that reveals where confidence breaks first. Gold is the ocean liner, deep, institutional, central bank adjacent, massive. Silver is the speedboat, smaller, more industrial, more easily yanked around, and far more sensitive to where the physical metal is actually sitting. When silver starts behaving like it's in the wrong place, it doesn't just move on emotion, it moves on math. And when the math tightens in silver, gold often gets pulled into the same narrative because funds don't trade these markets in isolation. They trade baskets, spreads, ratios, and risk-on versus risk-off regimes. Watch silver, and you're watching the edge of the system. Watch the edge, and you often see the break before the headline does. Here's the first uncomfortable truth. Paper silver isn't fake, but it is not the same product as a bar in a vault you can point to. Paper silver is a claim, a contract, a share, a promise with margin requirements, delivery rules, substitution options, and, this is crucial, escape hatches. Futures are standardized promises. You're long or short a contract that references silver, and most of the time it gets closed or rolled before anyone even thinks about delivery. Unallocated accounts are essentially credit to the institution. You're owed silver, but you're also exposed to the institution's balance sheet and their terms. ETFs and ETPs can be great tools for liquidity, but they are still wrappers with authorized participants, creation and redemption mechanics, and custody chains that work smoothly, until the world demands immediacy and specific bars in specific places. And that's why paper versus physical isn't a meme. It's a description of two markets that usually track each other, until they don't. Because physical silver is brutally simple. It's bars, coins, custody, transportation, refining, and the time it takes to move metal through the real world. Physical has friction. Physical has delays. Physical has premiums. Physical has dealers who run out of product and industrial buyers who don't care about your chart pattern. They care about whether they can secure supply for the next production cycle. So when the paper price says one thing and physical behavior says another, you don't ignore the physical market. You assume the paper market is temporarily winning the messaging war. And then you ask, how long can it keep winning if the real-world bid stays firm? Because if this one level breaks, the math changes. Now let's drop the hidden detail, the piece that reframes the whole story. The hidden detail is that the market stress doesn't show up first in the spot quote. It shows up in the willingness to lend metal in the shape of the curve. In tight precious metals markets, the signal is not the headline, silver is up or silver is down. The signal is when near-term access becomes more valuable than later access. That's what backwardation is whispering when it shows up in a market that normally prefers contango. That's what elevated lease rates are screaming when borrowing metal gets expensive. And that's what regional premiums reveal when metal flows like water toward the highest bid. These are not conspiracy words. These are incentive words. If it costs more to get metal now than later, someone is paying up for immediacy. If it costs more to borrow metal, someone is desperate to source it without buying it outright. And if a region is paying a premium, metal moves there, draining other pools, and the benchmark market starts to feel hollow, even if the global total tonnage has vanished. That's the mechanism, that's the tell. And if you only watch the price, you'll miss it. Now, why now? The calendar is the catalyst. Early January is when liquidity is weird, It's when desks are resetting risk, funds are rebalancing, and big commodity indices mechanically adjust weights. That's not opinion, it's structural. If a metal had a monster year, it often gets sold by rule, not by belief. And when you have rule-based selling colliding with a market that S already tight in the near term, you get the exact cocktail that produces savage whipsaws. Paper pressure that hits the screen hard and physical tightness that refuses to fully let go underneath. And here's the twist that most people miss. These index flows aren't small. When a major commodity index rebalances in early January, it can translate into billions of dollars in futures flows across gold and silver over a matter of days, concentrated into specific sessions and rolls. That doesn't mean the bull case is dead. It means the tape can lie temporarily because a machine is executing a mandate. And that S where retail gets emotionally manipulated because the market looks like it just rejecting higher prices, right when the underlying constraint is still there. But that's not the part that matters. The part that matters is what this pressure forces participants to do. In paper markets, the rule is collateral and risk limits. If silver pops, shorts face margin pressure. If silver drops, leverage longs face margin pressure. Either way, volatility shakes out weak balance sheets. That's not a morality play, it's market structure. The fastest money gets punished first, and the strongest hands accumulate when the stress is highest. And if you're holding metals as a macro hedge, the worst thing you can do is let paper volatility trick you into selling your hedge at the exact moment it asks, proving why it exists. So let's break down the core mechanic in plain language. Futures set the reference price because they're the deepest pool of tradable exposure. That's why the whole world stares at comics prints and treats them like the price. But price discovery is not divine truth. It's a function of where liquidity is, and liquidity can shift. When the physical market tightens in the benchmark location, think London, think deliverable flows, think vault availability, the futures price can still print all day, but the cost to convert paper into metal changes. That conversion friction is the wedge. It's where the real story lives. Because if more people try to move from paper claims into specific bars, the system doesn't magically produce bars. It reprices the ease of access. It raises premiums. It tightens spreads. It increases borrowing costs. And eventually, if the stress persists, the headline price has to reflect that tighter access. That's not hype, that's arbitrage. And arbitrage is ruthless. If Asia is paying a premium for physical, metal gets pulled into Asia. If the US vault system is absorbing bars because of policy uncertainty, London can look tight, even if total global inventories look fine. And when the benchmark pool looks tight, the paper market becomes more sensitive, more jumpy, more violent. That's why you're seeing these extreme swings. And that's why the next detail flips the whole setup. One of the most important narratives running under the surface is silver is in the wrong places. If you hear that and think it's abstract, translated into something physical, the world has multiple major silver pools. But the benchmark pricing and the most efficient lending and swapping machinery have historically been centered in specific locations. When large amounts of metal shift, whether because of tariff fears, financing incentives, or policy risk, the benchmark pool can become less liquid, even if another region has plenty. That fragmentation breaks the smoothness of the market. It's like having water in the system, but not in the pipe you were drinking from. And when the pipe runs thin, the price of the next sip spikes. That's why you can see regional premiums explode even when the screen price looks calm. And that's why a move can feel sudden. The market wasn't calm, it was coiled. Now let's stack proof, because this can't rest on one argument. First proof point, the price behavior itself. A market that is truly healthy and liquid doesn't debite print these jagged moves this frequently. Silver moving from low 70s into the 80s and then snapping back into the high 70s within days isn't a normal grind. That's a market where flows are dominating, where near-term liquidity thins, and where positioning is being forced to adjust in bursts. Second proof point, the curve. When you repeatedly see strength concentrated in the front, when near-term contracts behave firm relative to later months, you're seeing the market value immediacy. Even if you don't stare at the curve every day, you can feel it. The market is paying for now. Third proof point, borrowing costs. When lease rates rise, it's not because Twitter is excited. It's because borrowing physical metal has become expensive enough to matter. That's what happens when metal is harder to source for delivery chains, for short hedges, or for immediate settlement needs. Fourth proof point, inventory isn't one number. Vault holdings can be large, but what matters is what's deliverable, what's pledged, what's already spoken for, and what's in the right form and location. In precious metals, eligible doesn't mean available, and registered doesn't mean endless. The categories matter because they represent willingness to make metal available at a given price. When willingness drops, stress rises. Fifth proof point, on-the-ground symptoms. When retail premiums stay stubborn or dealers report delays even during a pullback, that's a physical signal. It says demand at the retail and small bar level is not clearing at the same price as the futures screen. Now add a sixth proof point: institutional flow plumbing. Metal-backed vehicles don't just reflect sentiment, they can translate sentiment into real buying or selling of physical, depending on structure and creation, redemption dynamics. If demand surges for liquid exposure, the authorized participants and underlying custody system have to source metal or source liquidity to hedge. That creates feedback. And feedback is what makes these moves feel like a switch flips. But wait, because the most dangerous part for investors is misunderstanding why gold holders should care. Gold can be the cleanest hedge, but when silver's physical stress intensifies, it often drags gold into a broader trust and reserves trade. If investors are buying metals because they distrust debt dynamics, geopolitics, and currency stability, silver becomes the high beta expression, and gold becomes the core collateral hedge. Funds rotate between them. The gold to silver ratio compresses when silver outperforms, and that ratio, trade alone, can fuel flows that amplify silver's moves without any new headline. In other words, silver can be pulled higher not only because of industrial demand, but because of portfolio math. And portfolio math doesn't ask for your permission, it executes. Now we need to talk about the supply chain reality that makes silver uniquely explosive. Silver isn't mined like gold. A huge portion of silver supply is byproduct supply, meaning the decision to increase supply isn't driven solely by silver prices. It's driven by what's happening in copper, lead, zinc, and other base metals that generate silver as a byproduct. That matters because if silver demand rises rapidly, supply can't instantly respond with a neat, more mines open, more silver appears. That's a slow machine. Refining and logistics add more friction. A bar isn't just silver atoms, it's refined, assayed, formed, transported, insured, vaulted. Lead times matter, and recycling isn't a magic lever either. Higher prices can increase recycling, but it's not instantaneous. It's constrained by collection, processing capacity, and economics. So when demand intensifies, especially industrial demand that is less price sensitive in the short run, tightness shows up first in deliverable pools and lending markets, and that's why the market can go from normal to violent fast. Now, layer in macro drivers, because this isn't happening in a vacuum. When gold is pushing record territory and still holding a strong bid, it's not just about jewelry. It's about rates, real yields, currency stress, and geopolitics. The moment the market expects easier policy, or fears fiscal strain, or worries about trade fragmentation, metals catch bids as alternative collateral. Silver adds a second engine: industry. Solar, electronics, electrification, and complex supply chains mean silver isn't only a fear trade. It can become a procurement trade, and procurement demand behaves differently from speculative demand. A trader can walk away. A manufacturer with production schedules can't. That's where the real pressure starts. And now the paper versus physical conflict becomes obvious. Paper markets can express enormous notional exposure with tiny actual metal movement. Physical markets can't. If enough participants decide they want metal, not exposure, then paper liquidity becomes a mirage and the price mechanism has to adjust, not because of a secret meeting, but because of settlement incentives. If the path from paper to physical becomes expensive or slow, participants either pay up or they step away, and when enough are forced to pay up, especially shorts who must manage delivery risk, the market squeezes, not in a meme way, in a margin and availability way. Now we need to be finance credible about the counterpoints, because this is where trust is earned. The honest counterpoint is that a tight market can still crash 15% in a week. It can. It often does. Why? Because paper positioning can overshoot, because funds can de-risk, because index rebalancing flows can slam the front, because profit-taking after record highs is rational, and because when volatility rises, leverage gets punished. Also, high prices do strain certain forms of demand. Jewelry demand can weaken, retail buyers can pause. Some industries can substitute or thrift, and if metal flows back into the benchmark pool, if the wrong places, problem eases, spreads can relax and the screen price can drop, even if the long-term story stays constructive. So the goal here isn't to predict a straight line up. The goal is to understand the regime. Volatility is the weapon, and it will be used against you. The market will try to make you emotionally commit at the worst time, then punish you for it. You'll feel euphoria at highs and despair at pullbacks. That cycle is designed to transfer metal and positioning from impatient hands to patient hands. So here's your viewer psychology shield. First, separate trend signal from noise. Trend signal is what the spreads and borrowing costs are doing, what the curve is doing, what the regional premiums are doing, what inventories are doing in deliverable terms, and what institutional flows are doing in a sustained way. Noise is the intraday wick, the single headline, the one session smash during thin liquidity. Second, pre-commit to a two-scenario lens so you don't get hypnotized by one outcome. Scenario 1 is a controlled pullback and retest. Silver cools off, tests a prior breakout zone, spreads stay relatively firm, premiums don't collapse, and then price resumes higher with confirmation. Scenario 2 is continuation squeeze and gap risk. Silver holds firm despite selling attempts. The curve stays tight, borrowing costs don't relax. And then a thin liquidity move rips higher with little chance to buy the dip. Both scenarios are plausible in this regime. The difference is what confirms them. And that's what we're going to anchor to because guessing is expensive. Now, let us get concrete about what to watch next over the next 1 to 2 weeks. Watch the calendar first. Early January flow windows matter because mechanical rebalancing and roll activity can create artificial pressure. If you see sharp selling during these windows that fails to break key support and fails to relax the tightness indicators, that's not bearish, it's absorption. It means supply is being taken. Second, watch how silver behaves around round number levels and prior swing points, because these are magnets for options hedging and stock clustering. You don't need perfect numbers, you need zones. In this regime, silver has shown it can whip from the low 70s to the 80s quickly, so think in bands. A support band where pullbacks repeatedly find bids and a resistance band where breakouts become self-fulfilling if liquidity thins. If silver holds above a recently defended zone after a sell program, that's information. Third, watch gold's posture. If gold holds firm near recent highs while silver is volatile, it often means the macro bid is still alive. If gold breaks down hard at the same time, silver is losing support, that's a different message. De-risking across the complex. Fourth, watch the access signals. If you have any way to track or observe lease rate commentary, near-term tightness talk, or persistent backwardation chatter, treat that as more important than a single price candle. When access stays expensive, it means the physical market hasn't relaxed. Fifth, watch physical premiums and availability anecdotes, not as gospel, but as a temperature check. If the screen sells off but the street doesn't fully follow, premiums stay elevated, product stays tight, that divergence matters. It's the market telling you the paper price is clearing paper, not metal. And that's where the real pressure starts. Now, let's tackle the biggest confusion. If physical is tight, why doesn't spot immediately explode and stay there? What's because spot is a reference. Because the paper market can overwhelm the screen in the short run through liquidity and leverage. Because many participants don't need delivery. Because some supply is there, just not where it needs to be. And because the system can temporarily relieve stress by shifting bars between vaults, by changing financing incentives, by widening premiums, and by letting volatility shake out demand. Think of volatility as rationing. When prices swing violently, some buyers step back. Some sellers step in. The market uses emotion to do what it can't do instantly through production. That's why your job is not to predict a smooth ride. Your job is to understand the mechanism so you don't become the market as exit liquidity. Now, about paper versus physical vehicles, because this matters if you actually own metals. The goal isn't to pick a side out of ideology. The goal is to match the vehicle to the risk you're taking. Physical ownership gives you direct exposure to premiums, custody, and liquidity constraints. It's slow to sell in panic, which can be a feature, not a bug, if you're using it as a hedge. Paper exposure gives you liquidity and ease, but it introduces counterparties, market structure risk, and the possibility that in extreme stress, the screen can be more volatile than your conviction. Allocated structures sit somewhere in between, depending on custody and terms. And the point is this: when the market is calm, all roads look similar. When the market is stressed, differences matter. And we are in a stressed regime. Now let's talk about the conflict force again, because it's subtle. The force trying to suppress or deny the move isn't a villain twirling a mustache. It's the combined incentive of large liquidity providers, hedgers, and mechanical funds, whose job is to keep spreads tradable, keep risk within limits, and keep the benchmark price anchored to a liquid venue. They don't wake up thinking, how do we hurt retail? They wake up thinking, how do we manage exposure? And in doing that, they can create the appearance of capping. Because they sell rallies to hedge inventory, they buy dips to reduce risk, and they use futures because that's the cleanest instrument. But when physical demand persists, those hedges become heavier, borrowing becomes more expensive, and the curve tightens. That's when the system shifts from managed to reactive, and reactive markets overshoot, both ways. Now, let's give you a simple invalidation framework, because without it, you're just hoping. The thesis that paper is lagging, physical weakens if the access signals relax. If backwardation disappears and stays gone, if borrowing costs compress meaningfully and stay compressed, if regional premiums collapse back to normal, and if physical availability visibly improves while price fails to reclaim key zones, then the pressure is easing. That doesn't mean silver is dead. It means the immediate squeeze conditions are cooling. Conversely, the thesis strengthens if price pullbacks fail to normalize those signals. If silver sells off, but the access stays tight, that's a coiled spring. If silver pushes back above a prior breakout band and holds while gold remains firm, the odds of the continuation squeeze rise. And in that scenario, your biggest risk isn't being wrong. It's gap risk. It's the market moving when you're waiting for a perfect entry that never comes. But the other side is real too. In scenario 1, the controlled pullback, the market can punish greed. It can drop fast, retest, and make everyone feel foolish. That's why risk framing matters. No guaranteed returns, no can't miss. In this regime, the correct thesis can still deliver the wrong experience if you're positioned too aggressively. Volatility will be used against you. Now here is the payoff I promised, the one metric everyone should watch if they want to stop being fooled by the screen. Watch the difference between price and access. In normal times, you can ignore it because the system is flush. In stressed times, it's everything. Access shows up as tightness in near-term structure, as borrowing costs that refuse to fall, as persistent premiums in regions that matter, and as the market paying up for immediacy. Price is the headline. Access is the truth underneath. If access stays expensive, the market is telling you silver is still being fought over in the real world, not just in the chart. And that's why gold and silver owners need to pay attention right now. Because when markets move into a regime where collateral, trust, and supply chain fragility dominate, precious metals don't behave like calm investments. They behave like contested assets. That's not comfortable, but it's honest. And if you can keep your head while the tape tries to steal it, you put yourself in the tiny minority that doesn't get emotionally harvested. So here's your near-term roadmap in one breath. Over the next 1 to 2 weeks, expect violent swings to continue, especially around scheduled flow windows and thin liquidity sessions. Expect headlines to weaponize every downtick as the squeeze is over and every uptick as the top is in. Ignore the drama. Watch whether silver holds its higher zone behavior relative to where it lived just days ago. Watch whether gold stays supported near its recent highs and keeps the macro bid alive. Watch whether the tightness indicators relax or stubbornly remain. If the market gives you a controlled pullback and retest and the access signals stay firm, that's the market offering you a second chance. If the market refuses to pull back cleanly and instead keeps snapping higher through resistance bands, respect the possibility that you're in a continuation squeeze regime where dips are shallow and gaps are real. And if the access signals normalize premiums fade and price breaks down through key support zones and fails to reclaim them, don't argue with it. Recognize that the immediate stress has cooled and the market is repricing the frenzy. That's how you stay rational. That's how you stay solvent. And one last thing, because this is where community matters. If you're the kind of investor who doesn't need a guru, who doesn't need certainty, who just wants to read the market, mechanics, and protect your capital while everyone else gets yanked around by emotion, then you're my people. Stay focused on the plumbing. Stay focused on what forces participants to act. And remember, headlines chase price, but spreads explain it, and access tells you who's cornered.